What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is Victor Haghani, a co-founding partner of the famous hedge fund Long-Term Capital Management, the current founder and CIO of financial advisor Elm Wealth, and the author of The Missing Billionaires, a book that seeks to improve the financial lives of its readers by giving them an investment framework focused on how much to invest, rather than what to invest in. In the episode's first hour, Victor explains his investment philosophy and his firm's approach to portfolio construction and management, including core financial concepts central to his framework like expected utility, lift versus drag, standard deviation as a measure of risk, variance, the shape of return distributions, and how to optimize position sizing and manage portfolio risk in a manner that is both rational and appropriate to your personal objectives and risk preferences. In the second hour, Victor explains his and Elm Wealth's process for onboarding new investors, including how they measure personal risk preferences, their advice on how to approach investing and spending in older age, how to take into account one's primary income stream when making investment decisions, tax loss harvesting, and much more. If you want access to that part of the conversation and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this highly educational and important conversation with my guest, Victor Haghani. Victor Haghani, welcome to Hidden Forces.
Oh, thank you, Demetri. Great to be here.
I'm excited to have you on, Victor. So before we get into the topic of your book, which I read recently, and I love it. I have a lot to say about what I enjoyed about it. It's called The Missing Billionaires. But before we get into it, and before we get into the addressing the question of where are all these billionaires and what that's about,
Yep.
What's your story? Like, tell me a little bit about you. I mean, besides what got you interested in finance, I'm interested in understanding a bit more about your life. Like, did you grow up in London? I know you lived there for a period of time. Like, what's your background?
Well, it's a mixture of things. I was born in New York City. I'll just do it linearly. Born in New York City, in Manhattan, lived there for a little while. Then my family moved to upstate New York on the Delaware River. And then when I was 13, moved to Iran. My dad was born in Iran, but came to the States in 1941, lived in Iran until the revolution, and then was sort of at loose ends for a while. Actually, as we were waiting to continue our lives after the revolution, I wound up being a ski bum in Chamonix for a couple of months as a 16-year-old, which was really an amazing, fun thing. And then I finished up high school and then did some other things, did my A-levels and wound up going to the London School of Economics, all in London. So from 79 until 84, I was in London. And then I got a job at Salomon Brothers back in New York in bond portfolio analysis. My first boss, Bob Koprash, wonderful guy. He was a professor at Rensselaer Polytechnic before coming to Wall Street. And he and some of his colleagues really just did a great job in helping people to understand all of this technology and ideas that were coming to Wall Street in the early and mid 80s as deregulation really got going. So all kinds of derivatives and options and so on. Bob was really at the forefront of explaining all of those things and analyzing all of those new products. And then after a couple of years at Salomon in bond portfolio analysis, I was invited to join the government arbitrage desk, which was wonderful. And that's where I with those partners and colleagues on the arbitrage desk is where I spent the rest of my Wall Street career, eventually going to LTCM as a founding partner, moving to London with my wife, having our 3 children in London. And then after LTCM collapsed in 1998, I stayed on as a partner and tried to help with the liquidation of LTCM that was then where the portfolio was then owned by a consortium of our biggest bank counterparties. And I helped my partners for a little while trying to get a successor hedge fund going, but I really wanted to take a break. And so I spent basically my 40s on a long sabbatical with my kids and my wife. I learned how to fly. I sort of had all these bucket list items, going fishing in Alaska, doing a lot of climbing and skiing and reading and trying to learn different languages and just really trying to make the most of my 40s, knowing that once my kids went off to university, I'd start some kind of work again. So I was also searching around for what work I would do. And then, around 2006-07, I really started to decide that I wanted to get my family's capital invested in a very simple, low-cost, diversified, long-only way. And eventually that led to the formation of Elm Wealth, wealth advisory, investment advisory practice, where we help people to invest in a low-cost way in index funds. We charge really low fees as part of that, trying to be cost-efficient, tax-efficient, risk-efficient. And eventually that led to writing the book that we're going to talk about, where, I just came to realize that, a good way of thinking about investing and financial decisions in general was to really think about what your objective function was and to recognize that we all are naturally risk averse. And this just became a central theme in how I thought about financial decisions. And I wanted to help other individuals and families to also get to the same kind of comfortable framework that I had arrived at, and my partner, James White, as well. And that brings the story more or less up to date. I guess the last part is that we moved to Jackson Hole about 6 years ago from London. My 3 kids are all in the States now doing different things. And that's where I'm talking to you from, is Jackson Hole.
I know a lot of people that have moved to either Montana or Wyoming, some people to Utah. They really love it there.
Yeah, it's a great life. It's
become a popular destination. What initially, just before we move to the book, what initially attracted you to finance? Because you went to LSE, so you had an interest in it before you actually started working in the field.
Yeah, so I studied finance at the London School of Economics, but also I was really interested in computer technology, and I worked for Motorola in my penultimate summer before graduating. So I was also really interested in tech. And I guess I don't know, I kind of fell into finance by default. It was the spring of my last year of university, and I didn't have a job. And some of my friends were applying to merchant banks. That's what investment banks were called in the UK. So I started to do that. And then that led to applying also to some of the US banks. And this job came up and I took it. There wasn't a huge amount of forethought into getting into finance. I wouldn't say it was a very proactive decision, honestly.
I heard you on another podcast say that the job offer from Salomon had a starting salary of $24,000, and you got another one from JP Morgan for $35,000. And you had this great story of advice that your father gave you at the time when you asked him which job you should take. And he asked you in which job, if you perform well, are you more likely to advance? And you said Salomon for sure, and you took the job. I thought that was really great advice that your father gave you.
Yeah, it really was. I mean, that was a proactive decision. And yeah, it really turned out great in terms of, the learning and the friends and the lifelong associations that I've had from Salomon have been great. So yeah, that's exactly right. You recounted that story exactly to the detail of how it came down.
Yeah, because it also shocked me to learn just how much salaries have inflated. The nominal value of salaries has inflated at the time. Obviously, finance has also become a more lucrative field since the early 1980s, so maybe that accounts for some of it, but that might shock people to hear that number, so it's stuck in my head. Okay, so let's fast forward now to Elm Wealth. Actually, one more question before we do that. How important was your experience at Long-Term Capital Management? And feel free to expound on this. How important was that experience in your progression in terms of how you view investing? So like, what was the view that you had in the 1980s, your time at Salomon, and when you started at LTCM? How did you approach investing? And then how did the experience at LTCM and the collapse in 1998 inform the evolution of your thinking and what led you to create Elm Wealth?
Great question. So I came out of university with kind of the standard finance education, learning CAPM, efficient markets, all sorts of things that are still pretty much the core of the curriculum today. But once I arrived at Salomon and working in fixed income, like I wasn't really focused on equities, on the equity market at all. So I was a, fixed income person. And then on the arbitrage desk, it was all fixed income completely. And only at LTCM did we start to dabble in some relative value trades in equities. So at Salomon and LTCM, I didn't really think about investing in equities at all. And while I was working at Salomon, with the savings that I was accumulating there, well, first of all, like half of my compensation was taken and put into Salomon stock. So I felt like my personal account already had quite a lot of risk. I was bullish on Salomon's prospects, as were many of us working there. So that felt kind of comfortable, but it was a lot of risk. And I kind of felt like, okay, I wasn't too focused on what I was doing with the rest of my savings, which was mostly just in money market funds at the time. But whatever I did do was like some sort of alpha generation. So like there were a bunch of trades that we could do while I was at Salomon. Like, for instance, there was a whole discounted dividend reinvestment programs that different companies ran so that you could, like if you were an investor in the company, they would allow you to reinvest dividends at a discount to the market price of the stock. And they would even let you invest more money than that into their stock at a discount. And a bunch of us sort of just got on this bandwagon where, we would buy some stock that had this program, and then we would take another like $500,000 and invest at a discount and then sell it a few days later. And, we were even doing some hedges. So like my mind was very much that the market afforded all kinds of, sort of money with no risk, alpha with very little risk.
Profitable opportunities for smart people like you.
Yeah. And so that was kind of in my head. And then at LTCM, my investment needs were completely fulfilled by just investing in our fund. So again, I wasn't giving much thought to the whole idea of investing. And it was like people were breaking down our door to invest with us. And so I could invest without paying an incentive fee. It was great. I was like, well, I got to put in most of my money. I know what we're doing. I love it. So I had a lot of our family's assets in LTCM. Luckily, not everything, but too much, even prospectively, as we'll talk about later. And then LTCM collapsed. I was out there in the world on my own on this sabbatical. And the first thing that I decided to do was I looked around and saw what all of my friends and people I respected were doing. And they were all just investing to get alpha. They were doing, angel investing, VC investing, private equity, distress, investing in hedge funds, talking about different trades and doing trades, like buying Japanese inflation-linked bonds on leverage at Merrill Lynch, for instance. And so I just started to do all of that too, because it made sense to me. I felt comfortable. I felt that was a good thing to do. And then like just one day I woke up and I was like, wait a second. I don't want to spend my life like this. This is not a good return on my limited time on this planet, number one. Number two, it's super tax inefficient. I sat down with my accountant one year and I was like, wait a second, why am I paying so much tax? I mean, I only made an 8% return. Why is my tax rate effectively like 60%? And he walked me through all of these deductions that I wasn't able to take against income and all of these early realizations and everything. And I was like, oh my goodness, my investing style is so tax inefficient as a high income US taxpayer. I've got to change something. And I said, I got to get simpler. I've got to go back to basics. And that was so right around 2006, 2007 is where my mind shifted towards wanting to be, a textbook investor, like an investor who takes a finance textbook and says, I'm going to invest like what's said in these pages, and what we were taught at university. And that started this whole, process that eventually led first my family to invest that way, then some close friends, and eventually, becoming a business with, we have 500 investors or so now that all really like this approach to investing in public markets.
What's funny about this conversation, I just want to make this sort of point, is that you're the equivalent of a professional athlete in the field of finance and investing. So you're at the top of your field in terms of experience, your time at Salomon, your time at LTCM, your degree at LSE. And yet you came to this decision that attempting to compete at this level and in this way didn't even necessarily make sense for you. It's a similar conversation, actually, that I had with a colleague that I mentioned to you before we started this conversation, who was on the show, a former colleague of yours, Andy Constant, who during our conversation said that he doesn't even know if he has alpha. How many of your colleagues have also come to a similar realization?
I think that with my friends and colleagues, it's the majority of them, I think, would say that. And, a good analogy for the whole thing is, my youngest son, Mark, was a very competitive college golfer. He played at University of Pennsylvania. He was captain of the team. He was in their number one spot for a long time. Really, really strong golfer. And he's now decided that he doesn't want to try to go pro, and he's taking a job in New York City as a software engineer. It's great, really exciting transition for him. And his approach to golf is that he doesn't really want to play much golf right now because he was playing at such a high level and he knew how much he had to put in and the environment that he needed to be in to be playing at the highest level, that he kind of feels like, well, if I can't, I'm not going to, I just won't perform competitively at the level that I want to play as soon as removed from that environment and from that level of attention and dedication and practice. So I think it kind of makes sense that somebody like Andy or myself, when we come out of the environment where we have all the support, where we're putting all of our focus, when we have all of the collaboration with other people that are smarter than we are. And yes, in that environment, it is quite possible, I think, to generate alpha. Now, how much of that alpha gets down to the investors, and how much of it is kept by the people that are actually generating it, and is that a fair share, and what does that look like after tax and so on? That those are really important questions. And so I can believe that there are people out there that are generating alpha, but as an investor, as a US taxable investor, I don't think that I can identify them. I think that takes a lot of time. And then, the after tax, after risk adjustment, after fee return to me is not worth it anymore, as a passive investor.
I mean, that's a great point because the returns are estimates. They're prospective. The costs are definite. You know what those are. So let's talk about the book. As I mentioned, the book is called The Missing Billionaires, A Guide to Better Financial Decisions. What led you to write this book? Now, obviously, I don't just mean what led you to start Elm Wealth, which is, there's a parallel process there, but specifically like the book. Was this something that you knew for a long time that you wanted to write? How did that come together? And who is the intended audience of the book? So,
look, I mean, everybody who writes a book is writing it because they think that there's a need or a gap, where that book is going to fill. But I think one of the things that's kind of maybe a little bit unusual about our motivation, James and I both, is that we wanted to write a book that we wish had existed, earlier on in our lives. That the books that we were given to read, I mean, away from, university textbooks that sort of talked about theory and so on, that, the kind of like the most passed around book on the Salomon Brothers trading floor when I started was Reminiscences of a Stock Operator. And, I was like reading that book and really trying to figure out, what is the lesson that I'm supposed to take from this book, in terms of what I should be doing. And, it was almost like a cultural rite of passage to read the book rather than giving me any real insights into investing. And, over time, there have been books that I've read that have really helped shape my thoughts about markets. I think Soros's Alchemy of Finance really got me thinking about, feedback loops and, and some of the larger scale macro effects that happen in markets. But overall, there was just not a book that I could point to that I was like, if I had read this book, it would have really helped me. It would have helped me to avoid some of the biggest mistakes that I made in my career. So, part of it was just writing for our younger selves. I mean, that was a big motivation in writing the book. Like, what handbook would I have wanted to be given back then when I started in the 1980s that might have really helped me a lot? And, there are a lot of, Reminiscences of a Stock Operator just happened to be the most popular book being handed around. I mean, there are other, great books out there, but there's, I didn't feel like there was one in particular that, hey, if I had had that, that would have done the trick for me. That would have really made a big impact. And that's what we wanted to write. So, the intended audience, I think the other thing that's really unusual, I think, about our book is that the intended audience is relatively small. It's people who are relatively financially sophisticated. And nobody writes to this audience. Every book on personal finance is written sort of for the lowest common denominator. And, it's assuming that, yes, maybe it will be useful to somebody that's sophisticated, but I want to make sure it's useful to, millions and millions of people. And we decided that we wanted to write something, for more financially sophisticated audience that was really in need of a book that would be interesting and useful to them, without trying to wade through one of these wonderful finance textbooks that has everything in it, but, it's just not practical for anybody to wade through anymore. I mean, all the finance textbooks are super mathematical and really difficult to get through unless you're in university and dedicating a lot of time to it.
So I love your reference to Livermore's Reminiscences of a Stock Operator and Soros's Alchemy of Finance. They are very different books in the sense that Reminiscences is kind of almost like a lifestyle, adventure story thing that really appeals to young people, perhaps especially young men who are, preparing for an adventurous life, and it gets very exciting. And Alchemy of Finance is much more philosophical, but both are really about how to beat the market, or that, putting forward evidence, so to speak, that suggests that you can beat the market, that it's you against the market. It's this, great challenge to overcome, which is very different than what your book is about, which I would say is it's really a collection of frameworks that come together to inform a larger framework of how to approach investing in a much more sort of systematic way that also takes into account behavioral biases and also probability distributions and what we know from the data about how people perform, costs, et cetera. Before I ask you what questions investors should be asking based on the work you've put forward in the book, what do you think most so this is, I guess what I'm getting at here is, when I got into investing as a younger man, I had that same mentality. I read The Alchemy of Finance, I read Reminiscences of a Stock Operator, and I approached it as like, I want to figure this thing out so that I can win. Yep. And that's the mentality that I came into it at, and I've since come to the opposite view. I've progressed towards the view that I think you really put forward convincingly in the book. How do you think most people approach investing today?
Well, I guess that we're really talking about people for whom most of their savings is happening through a 401k, at their employer. That's where they're doing their investing. And I think these days, that the options and the nudging that people are getting in their 401ks is leading a lot of those investors to taking their 401ks and putting them into index funds, into target date funds, into balanced funds, really pretty sensible investment choices for those people. Then we have a lot of other people out there who don't have access or the benefit of an employer-sponsored 401k. They're out there on their own. And, maybe they have a small business, or maybe they're service providers or whatever. And, those people are really underinvested in equities, I think. And also they're unbelievably underserved by their banking relationships, so, like the number of people that have got an account at Wells Fargo where they're earning zero on $20,000 or $50,000, it's an obscenity. I mean, really, it's just terrible, how that's happening. And, they're not investing in equities, and then they sort of, they're not earning anything on their bank deposits. And, in a lot of those cases, they might get drawn to, some high risk lottery ticket type of investing. So, I think that really is, we really need to think about it in different segments. And then, when we think about higher net worth investors, that, the majority of higher net worth investors, I think, still kind of feel that they're entitled to more than what the market offers, that they're doing things that they think are going to provide higher returns than what the market should and does offer. And so they're taking more concentrated types of investment risk and so on. And, they've sort of looked at the Buffett record and other people, and they're like, yeah, I mean, I can find really good companies and invest in them forever too. And the last 10 years has kind of made it seem like that's pretty easy, just, invest in these stocks that have been doing the best recently, and they really have just been on a long-term run. So there's been a lot of reinforcement of that. So I guess what I'm saying is it's like the, people who are working for companies where they have these 401ks are probably making the most sensible long-term investment decisions at the moment. And, at the other extremes, you have like people taking too much risk, perhaps at the higher end of wealth. And then at the lower end of wealth, people too much in cash and not doing a good job with their savings.
It's like the inverted version of the bell curve meme on the internet. I don't know if you're familiar with it, where people on the tails of distribution end up making it, whereas the people clustered around the mean end up poor and perpetually frustrated. But in any case, I think that was a great explanation. And I've actually been passing your book along to the people who fall into the category of people that have done very well in their career, very smart people, and feel entitled, as you say, or feel that also, just like they've been able to be successful at everything else, they can be successful at this too. And they subscribe to a lot of newsletters, pay thousands of dollars to try to beat the market, and end up underperforming if they had just been in an index fund. So let's now get to the frameworks that you put forward in the book and the overall framework that you put forward. Maybe we can approach it this way. So I asked you what question or how do you think most people approach investing? How do you think people should approach investing? What are the questions that people should be asking themselves if they're looking to invest for the long term?
Well, I think like the golden rules of investing are, and these are, you have to ask yourself if you believe these, that, the first one is, do you believe that there's, no extra return without taking more risk? Do you feel that somehow you can get return without taking much risk, get more return without taking much or any risk? If you believe that risk and return are always going to be connected to each other, that overall feeling is going to lead you to being much more realistic about what the market has to offer, and that the taking risks that can be diversified away aren't going to be risks that are likely to be rewarded. So you need to say, okay, if I want to try to get more return, I have to take more risk. What's a reasonable trade-off in the marketplace between risk and return? How much do I believe that markets are efficient? Like that, I think, is the first question that people have to ask themselves on the path towards making their financial decisions. The second one is that, okay, so now I've decided, let's say I'm in this camp where I need to take risk in order to get more return. Now I have to answer the question of, for a given ratio of return and risk, how much risk do I want to take? And that really comes down to thinking about what is my personal level of risk aversion and how do I apply that to answering the question. So, if the market is offering an extra 5% return relative to investing in safe assets with 15%, up or down risk, standard deviation, let's call it, per year. I mean, we don't need to think about this as a normal distribution. We can, think about it in its full reality with fat tails and jumps and all of that. But, I'm just saying if basically the risk return trade-off is 5% of return for taking 15% risk, how much risk do I want to take? And that's a personal risk aversion question. The answer is not, I want to just take as much risk as I possibly can to get as much return as I can. That takes you to a weird place where, you're going to have a high chance of losing all your money in any given year if you followed that to its logical conclusion. So I think approaching it by first answering the question about how efficient do I think markets are in terms of the risk return trade-off, and then coming down to, okay, well then what is my personal preferences for return and risk, and coming up with how to build my portfolio from that and how to change it over time.
So in the first few chapters of the book, you go through some pretty basic math and you put forward some formulas, including the Burton share, which kind of captures what you're talking about here, and two very important concepts that are relevant to that are this notion of expected value or the mean of a distribution and standard deviation, which is a measure of risk based on the dispersion around the expected value or the mean. How important are these concepts to understand? And as far as standard deviation is concerned, how useful is that or even accurate is that as a measure of financial risk?
Sure. So we have to realize that the Merton share, and we talk about this a lot in the book, that the Merton share is a rule of thumb. And, it's a rule of thumb which is based on a simplified representation of expected return and risk.
I should also mention for people, the Merton share is optimal bet size is equal to expected value over your risk preference times standard deviation squared.
The standard
right?
deviation squared. Yes,
right.
Exactly. Yep. So it's like, for math geeks, it's mu divided by gamma and by the quantity gamma times sigma squared in the denominator. So the Merton share is a rule of thumb that we use to illustrate the trade-off between return and risk in a stylized way. For investing in equities or any financial assets, we know that the risk on those investments is not well described by the normal distribution, that the downside risk is always going to be greater than the probability of really consequential downside outcomes is always going to be greater than kind of what's implied by the day-to-day normal movements of financial asset prices. We know that they have fat tails. We know that they have really fat and skewed downside tails. And we have, theories and intuition, as to why that's the case. And the full framework is that you're trying to maximize your expected utility. Now, the Merton share just drops out as a formula based on a simplistic representation of reality. But we can easily take our own preferences with regard to risk and return and use a much more realistic distribution of outcomes for asset prices to come up with sensible portfolios for ourselves. And, in general, the allocation to risky assets will be more conservative than what you would get by just looking at the normal day-to-day movements, because we know that there's this big fat left tail of potential losses. We also know that we can't rebalance our portfolio every day or every minute, that it jumps and it gaps. And that's a big problem too, when we're thinking about, this sort of risk-adjusted return optimization for our personal wealth.
So actually, you're kind of touching on a couple of questions that I wanted to ask you with respect to how you approach advising or working with your clients at Elm Wealth, and maybe we can do that in the second hour. Before we do, I still want to work through some additional concepts. So you mentioned utility. Is the connection to draw here that the Merton share focuses on expected value in monetary terms, but that actually you can make adjustments to that so that in replace of monetary terms, you're actually thinking about personal utility that captures some broader measure of happiness or whatever? Is that sort of the idea?
No, the Merton share, is exactly tied to, the idea that what we want to optimize in our lives is the welfare or enjoyment or happiness that our wealth brings us as we spend it or give it away. And it just turns out that the Merton share, is this really simplified formula that we get when we really simplify the representation of the world. But it still is based on a utility function, a simple utility function that has some really nice properties that, combined with geometric Brownian motion or a random walk of asset prices, gives us this super simple formula.
So another concept that's relevant to this is lift and drag, or volatility drag, as they pertain to portfolio performance and how we think about risk and reward. What are these concepts and why are they important to understand? And how are they related to what we're talking about now?
So the idea of volatility drag is really just saying that, listen, if I make 50% on my capital one year and lose 50% the next, or lose 50% one year and make 50% the next, even though my average annual return was zero, the average of plus 50 and minus 50 is zero, that I've lost 25% of my wealth, right? I went up to 150, then down to 75. And that loss of 25%, even though my average return was zero, the loss of 25% is what we call volatility drag. And so, risk literally eats compound returns. It's not eating into the average annual return, but it's the compound return that matters to us. That's driving the value of our wealth and what we can use our wealth for. And so volatility drag is a really easy way of seeing that when you get to high risk levels, that even though our expected return on our portfolio is getting higher and higher, the median outcomes, the outcomes that are most likely to happen, get worse and worse. And I think that, volatility drag is just a really intuitive way of seeing what's going on with risk and compound return. Now, it also happens to tie into one particular, if your utility curve or if your utility preferences happen to be well described by somebody that has what we would call log utility, where their utility equals the natural logarithm of their wealth, which happens to just be like the simplest thing you could write down, for some sort of concave function where the more wealth you have, the more happiness you have, but at a decreasing pace, then all you would care about is volatility drag. But if you have greater risk aversion to that, then that volatility drag is even a more and more important thing and gets multiplied by that greater degree of risk aversion that you have. But it's just the simplest way to show how risk really does have a cost in terms of what we care about, which are our most central outcomes, and how it just can't be right that if you find something attractive, that you just want to own as much of it as possible, that you just don't want to maximize your expected wealth. You want to maximize your expected happiness that you derive from your wealth. That's the right objective function, not wealth itself. If it's wealth itself, it takes you to crazy things where, you're almost guaranteed to lose all your money.
Yeah, and you go through some of those examples in the book, and you also have places on your website at Elm Wealth where people can actually play some of these games, and I think they're very useful. So does equity market volatility matter if you're invested for the long term and what you're invested in, let's say equities, the particular equities you're invested in don't yield dividends? I mean, does it make a difference if the portfolio is volatile? In other words, how does the drag manifest in that case?
Oh, absolutely. So if you don't care about the risk, right, then you would look at equities and say, well, let's say I think that equities...
Well, sorry, just to clarify what I mean, but in this case, risk as measured as standard deviation, volatility around expected returns, not necessarily, uncertainty or catastrophic risk, but just this mathematical expression of volatility over time, how would that impact your portfolio adversely if you don't plant eggs for 10 or 20 years and there's no income that's being derived and therefore compounding?
Right. So to be in a world where we don't care about day-to-day movements, but we do care about large drawdowns, is to live in a world that just can't tie into reality. I mean, the only way that we can lose 50% of our money on an equity portfolio is really to first lose 10% and then, at some point 20% and all the way to 50%. That sure, I mean, it could be that there could be a process out there where the equity market has a daily volatility of 0.5% a day, and there's a 1% probability each year that it's down 50%. Well, I don't think that's a really great model, but let's say that we like that model. The problem is that 0.5% a day of movement is still moving the stock market up or down by, say a standard deviation of 8% a year. So after 3 or 4 years, now you might be down 20%. So the question is, what's your jump now? Is the jump still just down 50% from the beginning? Or are you now saying that, well, stocks are down 20% and now there's still a 1% chance that they go down another 50%? So, I think that it's really hard to get yourself to a place where you just don't care about the normal volatility. I mean, you don't care about it if it's really small. But if it's moving around by 0.5% a day or 1% a day, and you also have a jump, you're going to care about both of them. And again, the volatility drag is like this, is just a really intuitive way to see how risk is affecting things. At the end of the day, what you care about is, what do you think is the distribution of outcomes for your investment to a horizon, given a particular investment strategy? Maybe you're buy and hold, maybe you're going to try to maintain a fixed percentage in equities, whatever your approach is. And now you can just calculate the expected utility and decide on what's the optimal strategy for you to take, or the optimal setting, given you, if you select a strategy, then you use that framework to figure out the optimal setting of that strategy. So if it's buy and hold, it's like, okay, well, how much do I buy? If it's keeping a fixed percentage, then what percentage is it? But, I think that the day-to-day volatility is going to still be relevant, in that kind of modeling, unless, again, all you really care about is down 50% from some arbitrary starting date. But that doesn't feel like a really satisfying representation, of the world, because when you do get to down 50%, if that happens, then what? Then you can't go down anymore. Like you need to have like some distribution which has some consistency through time, or some process that has some consistency through time that you want to model. But whatever you model, then you can figure out what's the optimal thing to do. Whatever you believe the distribution is, then you're going to try to optimize based on your risk aversion and your risk preferences for what strategy is best for you.
How do you weigh the benefits of dynamic asset allocation with the higher costs of transaction fees and also potentially capital gains costs?
Sure. So I think that the cost of dynamic asset allocation, as you said, is greater transactions cost, although these days the transactions cost are pretty de minimis. Most of the big ETFs are very liquid, have very tight bid-ask spreads. Most platforms allow you to trade them without commissions. So, I think the transactions cost part of it isn't too big. It's still something, but it's not too big. And then from a tax point of view, dynamic asset allocation is always going to be less tax efficient than a buy and hold strategy. But if you combine dynamic asset allocation with tax loss harvesting, you get pretty close to somebody who is not doing a buy and hold, but decides they want to have a certain percentage in equities all the time, because that person also needs to rebalance from time to time. Not nearly as much as a dynamic asset allocator, but still. So the dynamic asset allocation can be done in a reasonably tax efficient way, roughly as tax efficient as somebody that's trying to maintain a static asset allocation to equities of 60 or 70%. Obviously, if they want to have 100% in equities all the time, that's the same as buy and hold. They're not really changing anything. So those are the costs of dynamic asset allocation. And I think the benefits are twofold. The first benefit is that it should give you a better risk-adjusted return, because you're making your portfolio be the right portfolio at every moment in time in terms of the expected return and riskiness of the market at that time. So you're keeping your portfolio as the optimal portfolio all the time, and that should give you a higher risk-adjusted return. In historical studies, in thought experiments, et cetera, we think that you can get an extra 100 basis points of risk-adjusted return, or maybe more than that in non-risk-adjusted return, but say 100 basis points of extra risk-adjusted return, which is really substantial, given that the risk-adjusted return of a balanced portfolio is just a couple of percent anyway above the risk-free asset. So we think there's a significant improvement in risk-adjusted return over the long term. That's one benefit. And that far outweighs the transactions cost and tax costs of the dynamic aspect. But the second benefit might be even more powerful, which is that nobody really is static. Nobody really can stay static, or very few people stay static over time, even if that's what their chosen strategy is to begin with. They decide, okay, I'm going to just do this 70% in equities, 30% in fixed income, half and half US, non-US. And they say, that's my strategy forever. That's what I'm going to do. Well, the empirical evidence is that very few people stick to that for more than a few years at a time. After 2 or 3 years, they look and they say, oh my goodness, tips are at minus 1%. I don't want to own any fixed income. Then they look at equities and they're like, oh, US equities have been outperforming non-US equities by 5% a year for the last 5 years. Why do I own these non-US equities? And so after 3 or 4 years, they change their portfolio dramatically in an ad hoc way. And a disciplined dynamic asset allocation approach is really going to save you, even if it doesn't produce a higher risk-adjusted return, which I think it should. It's just going to save you from really hurting yourself by doing very subjective, seat of the pants, dynamic asset allocation anyway. So, I think that we have to accept that we're going to change our asset allocation. And then the question is, do you want to do it in a disciplined way, or do you want to do it when your mood and the news and everything conspire to push you over the threshold and to make a change? Mm-hmm. And then when do you make the next change? It's just, I think the evidence out there is that most investors, when doing it in a subjective way, really underperform a static portfolio by a lot, right? We have all this evidence out there on that sort of thing.
Yeah, I mean, so that obviously speaks to behavioral biases. And there's been, I think, a sea change in the field the last few decades around people's awareness of these biases, and a lot of books have been written, et cetera. But it also speaks to this mantra that you hear repeated a lot in financial, which is that past performance is not indicative of future return, not necessarily indicative of future return. And yet, one of the most important questions people want to know is like, what is past performance? And even in this example, like, what did the stock market do the last 5 years? What's been going on the last 2 years? Like, people are so influenced by that. Is that a big source of trouble for most investors? Looking at what's been hot, trying to assess, how things have performed, and then making adjustments according to that metric?
Yeah, I mean, I think that that's by far the biggest personal problem that we face in investing, by far. And it's institutional, it's individual, it's institutional, it's everywhere. It's like, it just seems to be inescapable. I think that's the biggest. I'm trying to think what the second biggest is, in terms of how big the gap is between the first biggest and the second biggest. But I think by far, return chasing, extrapolating from too little data is just so hard for us to overcome. We did, if I can go just a little bit longer on this question, you're probably familiar with an experiment that we did about 6 years ago, and we wrote a paper on it where we asked our readership, which is a pretty bunch of financially sophisticated folks, we asked our readership to answer this question. You're presented with two coins. One of them, you're told, is a fair coin. It has a 50% chance of landing on heads. The other coin is a coin which is biased to land on heads with a 60% probability. So you know that one of these coins is fair, one of these coins has a 60% heads bias, but you don't know which is which. And you're allowed to flip both of them some number of times. And obviously, whichever one lands on heads more is the one that you think, that you should rationally think is the biased one, right? So the question is, how many times, what's the minimum number of times that you want to be able to flip those coins? You're going to choose some number of times to flip them such that you'll have a 95% confidence that you've identified the biased coin. And, we got answers back from a few hundred of our readers, and we asked them to not calculate it. We said, please just give us your intuition on this. Please don't set up a spreadsheet and figure it out like that. And probably some of them did anyway. But the median answer that we got back from people was like 15 flips, I think, something like that. I don't remember exactly what it was, but it was low because the right answer, the mathematically correct answer, is like 143. And, I think that's such a powerful indication of how we just think that, a relatively small data set gives us these answers. And 140 times to get to that level of confidence, realizing that if you just chose randomly without any flips, you have a 50-50 chance of getting it right. But you need to do another 140 to go from 50% to really being pretty sure that you've got the right coin.
I think that's great. And actually, I sat down and I told you we were supposed to do this interview several weeks ago, but I had nearly finished the book, and I realized I actually wanted to go back to play around with some of the thought experiments and also with some of the games on your website. And I actually did that coin flipping exercise. And when I did it, I got a number of flips going against me. And even though I had no money on the line at all, and I understood with 100% certainty what the probabilities were, which is something that you cannot know in financial markets, I got this feeling of like, what is wrong? Why are so many flips going against me when it's a 60-40 probability? And I think that replicates the experience that people have when they choose a strategy and then the strategy doesn't seem to be working because they're so impatient and because the way that we experience the distribution is very different than how it actually is empirically.
Right. Randomness just doesn't feel random, right? There's the famous, I think probably all of your listeners know about how Spotify if you ask for a random shuffle, they don't give you a random shuffle because people said that's not random. So they give you a non-random shuffle that feels more random, even though it's not random, right?
Yeah. This reminds me of a great story that I read in a book some years ago referencing von Neumann, or maybe it was Andrei Kolmogorov. Anyway, the conversation dealt with the philosophical problem of randomness and what constitutes a random number. Because certain numbers might be random, but they don't feel random. 1, 2, 3, 4, 5 does not feel like a random number, even if it is. And this is further complicated by the fact that you can't actually prove it. You can't prove that a number is random. You may just not have found the algorithm that computes it yet, which speaks to your point about the Spotify stuff. So, Victor, I'm going to move us to the second hour where I want to focus more on understanding your process, how you work with investors and those that hire Elm Wealth to manage their portfolio, how you measure their personal risk aversion, and also special situations. And I don't mean investment situations. I mean independent variables like your age, for example. How should you approach investing and spending in retirement or at an older age where your primary income is declining or coming to an end? How should you approach investing depending on where your primary income is coming from? For instance, are you an investment banker or are you a doctor? There are so many things to consider and that I'd like to ask you in the second hour. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Victor, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Victor, stick around. We're going to move the rest of our conversation onto the premium feed.
Okay, great.
If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.